Hey, Gutsy Women Finance friends, it's Dr. Brenda. Today we're going to talk about investing, and yes, I am recording this presentation separately so that when you come to our live workshops, you feel absolutely free to participate and ask questions and talk about your personal situation, and we keep that information confidential. So I am also going to be attaching this presentation as a PDF because I've got a lot of links in here. So you'll want to look at that PDF and go to those links and do a little bit of research. Investing 101. Generally, here's what I find as a financial coach working primarily with women. Women are great savers. Great at saving. But when I ask about investing, there's this sort of look in the eyes like, yeah, I know I should be doing this. Yeah, I know, I know, but, and consequently, they stockpile a bunch of money in their savings accounts. So, because they're afraid of investing, they don't know how to invest. So I thought this is going to be a great opportunity for you guys to just get started. You don't need to know all of you're not going to be a day trader. I'm not going to teach you how to be a day trader. I want to teach you how to safely invest, how to decide where to invest, how to get started. So let's go ahead and begin with Investing 101. So the first thing that we talk about is what you learned about investing growing up. And if you're like me, you learned probably nothing at all. I learned about savings, did not learn anything about investing. And of course, part of this is generational because when I was younger, you didn't have access to a stockbroker. You didn't have access to the market generally. So it wasn't like today where you can open up an account online and begin making small investments and just practicing. It just didn't work that way. So I learned absolutely nothing about investing. And if you're in that situation, or maybe you saw your family member invest and lose or get caught up in investing, that has definitely impacted where you are today. So I want you to think about what you learned growing up about investing and how that makes you feel. Do you feel excited about it? Do you feel reluctant about it? How about anxious? Maybe a mix of those two. So before we begin, just, take out some. Yeah, I'd love for you to follow along. Not follow along. I want you to participate, guys. So, I always keep a notepad with me. I keep a bunch of pens. So I am ready to take notes and help you guys as you ask questions. I want you to be able to take notes too. And you can pause this. Give yourself some time to think about what you learned about investing and how you feel about investing. That's the starting point. Investing simply means that you are buying shares of a company. You are buying shares of ownership in a public company. Now that's for stock investing. Investing is certainly beyond that. Real estate investing, bond market investing. But those shares are known as the company's stock. By investing in it, you're hoping the company grows and performs well over time. And if that happens, your shares become more valuable. Some companies may also give you a share of their quarterly dividends. Other investors may be willing to buy them from you for more than you paid for them, which will earn you a profit when you sell them. You're making a purchase. You're hoping that purchase increases in value. And when you're ready to sell it, you're making more money. You're making that money, right? Others, the dividends, I have bought into companies that primarily the stock prices stays the same, but as I keep buying more, I keep reliable dividends. It's basically free income coming in to me every quarter. So there's nothing really complicated about it. It's really that basic. What's stopping us very often is when you start doing the research here. When you start doing the research, you'll see that there are a zillion different doors to walk through, and there's somebody to tell you to walk into every one of those doors. it is decision paralysis. It's overwhelming. Which door do you walk through? How do you get started? So today I'm going to help us take some of the mystery out of it so that you walk through that single door. Saving and investing, what's the difference? Yes, women like to save because they know they can get that money when something bad goes on. They've got that money. They can pull it for an emergency. And that is absolutely true. Yes, have money in saving, but it's not going to grow. Right now, as I record this, we are living in a very high inflationary time. Price of food is going up. The price of gasoline is skyrocketing. That money in your savings account, maybe making 1% at best, is not keeping up with those higher costs. Investing, on the other hand, yeah, you can lose some of those funds. You can lose all of those funds. It fluctuates from one week to another as the markets go up. Your money's up, your money's down, but over time, over the long run, you're going to have significant rates of return, averaging generally historically about 10%. There's no guarantee that will continue. But that is why people invest, because their money grows. That's what it comes down to. In terms of investing, think about your time frame. So you want emergency funds to be in that safe, secure savings account. You want some cash to be available when you need it, but you also want that money in the savings account, up to a year of savings. So that can go into your savings, checking account, money market. Then you begin to look in the short term, funds that you might need available in 1 to 3 years. So maybe you want to buy a car in 2 years. And you don't need all that money sitting in a savings account, but maybe you can put some money into a CD, into bond funds, into sort of a balanced index fund, one that has both bonds and stocks. When you go into the medium term, and especially the long term, you can become more aggressive with your investment. So if you're talking about 4 to 9 years, you're going to be more likely to be invested in bonds and balanced funds, municipal bonds, REITs, which are real estate investment trusts. And I know I'm throwing out a lot of language here. We'll get into some of that later. And yeah, pop into the live version so you can ask these questions and I can get you a good response to those questions. Long-term, 10 or more, you primarily want to be invested in stocks, the stock market, index funds, real estate. So your time frame is a primary factor on determining how much you're putting into each of these pockets, each of those baskets. Okay, there's something called the Rule of 72. And it is a way to estimate how long an investment is going to take to double. So by dividing 72 by the annual rate of return, you get a rough estimate of how many years it will take the initial investment to double. Whoa, what's that? Well, let me tell you what. I put together a spreadsheet. I think I started this spreadsheet almost 20 years ago. It's an Excel spreadsheet. And I started when my retirement account hit like $100,000. I mark the date down and I'm like, well, what happens if it doubles in 7 years? What happens if it doubles in 5 years? What happens if it doubles in 10 years? And I have tracked how long it takes for that account to double. And yes, when you continue to invest, it doubles quicker. But this Rule of 72 works like a charm. So if you have your money sitting in a savings account, 1% interest, you're taking 72 divided by that 1 for the 1%. Hey, your money's going to double in 72 years. Okay, so, you guys do the math. You're 40 years old. You've got $100,000 in your savings account. It'll turn into $200,000 when you are 112. Okay, that's no way to go, right? So that is the vivid example of how that Rule of 72, what it means in actual years, in actual dollars. Now, if you are investing, and let's say 8% is a pretty average return, that can be that is not unreasonable at all. So let's say you're invested in a combination of stocks and bond funds. Maybe it's some real estate, index funds, which we'll get to later. So let's say you earn 8% on average. Now, one year you might earn 16%, another year you might be down 2%. It again is going to jump. But over the long term, let's average it out to 8%. 72 divided by 8, your money's going to double in 9 years. So now let's take that $100,000. You're 40 years old. You're earning 8%. By the time you're 49, that $100,000 has turned into $200,000, and that assumes you're not making any more investments. You're talking about some pretty big money, right? So as you go up, 10%, that's been the average of the stock market. 12%, that's a pretty difficult average to obtain, but it shows you over time, if you earn 10%, your money actually doubles in 7.2 years. So instead of 49, you're 47 when your 100,000 turns into 200,000. Hey, if you got 12%, that'd be fantastic. Now you're down to 6 years. Now you're 46 when your money goes from 100 to 200. So that's a really, really easy way to sort of calculate how long it might take your investment, your savings, or your investment to double based on those rates of return. So very, very good, quick way to do that. So this again, I have always used this future value calculator. I have the link. Go into the PDF. The link will connect you to that calculator. Experiment with different amounts of money that you use your actual figures. Put in how much you have. Put in, 8 to 10% in terms of how much you can expect on your investment return, assuming it's not stuck in savings. How much you contribute. Play with those numbers. You might be really surprised because time is that magic ingredient that works in our favor generally. Okay. Now, investing goals. You're taking this workshop. You're in Gutsy Women Finances. You want to learn how to invest. And these are some of the three of the common things that I see. And people want to choose their stocks and the stock funds on their own. Okay, so that's one type of investor. A lot of people don't want to go there. Others are like, you know what? I own some shares in Apple and this has done really well for me, or Amazon, or whatever the case may be. They want to actually pick out their own stocks. Other folks would like to just use an automated program that manages the process for me. So we'll go into that later, but there are now robo-advisors. So I can say I'm going to spend $100 each month, and that is going to be automatically distributed into these investments based on my goals and my time frame. It's all automated for me. Then there's the other case too, where you're still working. And you have, if you're an entrepreneur out there, this is your own retirement account, or if you are working for an employer, you want to learn how to invest in your employer's retirement fund. So hopefully you are contributing now, but you feel kind of lost as to how you're allocating those funds. So those are the three investing goals that I see most often. And sometimes it's a combination. Maybe somebody wants to dabble just a little bit in the stock market, but most of their money they want to have it automated. And for everybody there who has an employer, absolutely you want to learn how to invest those retirement funds. We're going to take this down into 3 steps. Okay. Open an account, do your research, and invest, and keep learning. This is a constant learning process. So let's walk through these each step at a time. So you're going to open an account. And again, this is so much easier than it ever used to be. Now, to open an account, the first thing I want you to think about is taxes. Oh, taxes. Oh, taxes. What do I have to pay taxes on? Oh, taxes. I know what you're thinking. So what's the difference between investing in your retirement account versus investing outside of your retirement account? And that's going to be taxable. So with your taxable account, brokerage account, your taxable investment account, you're going to have to pay capital gains taxes on investment income. You can contribute as much as you like. There are no limits or penalties. This is your money. And you're going to use this primarily for mid and long-term investments beyond retirement accounts. Now, what I recommend to most people is to put as much money into your retirement accounts as possible because it has huge tax advantages. So if you're looking at money that you've invested, you are investing in your retirement account, typically you're not paying those capital gains. It's either the taxes, you won't be paying the taxes until you take it out. That's a traditional retirement account. Or it's growing tax free, meaning you've already paid the taxes, a Roth account, and it's growing, you're not going to be paying taxes ever again. So you get these huge tax benefits, but there are caps. The government does set up caps. The IRS sets up caps on how much you can contribute, and this changes every year. So every year the IRS comes out with new caps on how much you can contribute. There are penalties for withdrawing before a certain age, unless certain exceptions are met. And you're going to use this for long-term growth and retirement savings. Okay. And yes, I do talk about financial independence and financial freedom. And there are ways to tap into those retirement accounts early without penalties for early retirement. That really involves an entire presentation. So if you let me know if you're interested in that process, though, that concept, just connect with me and say, hey, yep, I'd love for you to do a workshop on how to get your money out of the retirement accounts if you leave the workforce early. Okay. Fees. 1 minute. I love low fees. I hate high fees. There's no reason to be paying high fees. People don't even look at the fees associated with their retirement accounts. So, especially when you have a company account, like, oh, well, I don't pay fees. Well, yeah, you do. You're not paying for that advisor, but there's a certain amount of administrative and management fees that you are paying for. And the fees can be, well, let's just use this example. Let's take a 25-year-old. Her name is Janie. She's got $25,000 in her retirement account. Every year she adds $10,000 to her account. She earns a 7% annual return, which is pretty reasonable, very conservative. She wants to retire in 40 years. Of course, if we're Janie, maybe we want to retire in 30 years or 20 years. Cool, right? So let's say she pays 1% in fees, and that's going to cost her more than, yeah, that's not a typo, $590,000 in returns over 40 years of saving. 1% adds up, 1% of her portfolio. She's going to be making, this is going to add up to a lot of money. But paying those extra fees, paying 1% in fees, is going to whittle that money down. And it's unnoticeable for the most part. You don't notice it quarter by quarter, year by year, but over the long run, over 40 years, it adds up. So let's say she can choose whether to invest in a managed fund at 1% or these index funds where they're not managed, they just track the market. If she does that, one is that 1% fee that she's paying, the other is 0.07%, okay? 0.07% for an index fee. She's going to save nearly $215,000 in fees. She's going to retire over $500,000 richer. Okay, so I hope that drives home the issue of fees. They really do matter. You're going to look for index funds. You're going to look for low fee options that track the market. You're going to rebalance periodically. Low fee index funds are the way to go. You're going to run into financial advisors that promise that they can always beat the market. Can't be done. Can't be done. Maybe one year they beat the market, next year they're down, and they're taking a lot of your money along with it. So index funds are really the way to go. How do you get started? In the United States, the two companies that I like the most that have the longest history, and there are so many other companies out there now, but Vanguard and Fidelity are two companies that offer all kinds of low-fee index funds. Usually, you can get started for a pretty decent entry point. And I have funds at Vanguard. People love Fidelity too. And either one of these, you can't go wrong. Very easy to open an account. Look at the minimums. You might need $3,000 to open an account, but those are two of the. And I have no stake in the game. These are not my affiliate links. I have no connection with those companies other than, yes, I do and have investments in Vanguard. Okay. There are so many online brokers now. So this is an article. It's updated all the time. It's NerdWallet, the best online stockbrokers for beginners. And again, go to your PDF, go to the article, take a look at the online brokers there. But there's so many now do-it-yourself options. And there's no reason to not start. There really is no reason to not start investing. And again, we've got robo-advisors. So those are some of the best robo-advisors. The robo-advisors, this is, I'll use an example of Betterment. I have invested in Betterment for a long time. They were one of the first people. And again, what it means is I set a goal. Let's say I want to buy a car and I want to buy it in 5 years. And this is how much my initial investment is. This is how much I can invest regularly. They dial it up or down. Now, I can change that dial, but given my goal, given my time frame, given how much money I need, they're going to advise me. They're going to invest that money automatically, and they use index funds. So generally, my fees remain low, and they will dial the options according to my time frame. They will also send me advice and says, hey, you know what? I don't think you're going to make it. The odds of you making it to this point are not very good. Here's what you can do. You can add a lump sum of this much or increase your monthly contributions by this much. So these robo-advisors are very clever. They keep the fees low, and they're a good way to get started and to learn how to invest. And again, get that PDF, go to that article. I mentioned index funds. I've been talking about index funds and haven't really explained it. What index funds are is it's an automated way to track the market. So you can buy an index fund that just tracks the U.S. stock market. It tracks the S&P 500. It tracks international stocks. There's not a human being there. It's just, you're just mimicking the market. So your funds do as well or as poor as the market goes. Fees are very low because you don't have that human intervention. And index funds over time actually outperform the humans who tend to, buy and sell at just the wrong times. And both of these can be used to sort of bundle together stocks and bonds, different types of investments into one particular item that you're just buying. So index funds and exchange traded funds generally are exactly the same thing. Index funds are used mostly in retirement accounts because you can't buy and sell them throughout the day. Exchange traded funds, you can. So if it's, 2:00 here in the afternoon and I wanted to make a purchase or I wanted to sell, I can do that with exchange traded funds. With index funds, I'd have to wait till the market closes and then do it. It doesn't really make a difference to me, but I want you to understand the terminology, so people will use index funds and ETFs interchangeably very often. There's very little difference between them. Thing I love, again, is very low fees, and you can do this yourself. Absolutely. So you want to do your research and you want to make wise investments. How do you do the research? Okay, so before we Continue on there. Can you do this matching game for me? I know this is recorded, so we'll have to you'll get to cheat a little bit here. But index funds. I can't pull this over, but index funds belong here, a type of fund designed to match or track the financial markets. I haven't talked about this at all. Dollar cost averaging. Dollar cost averaging is connected here. You're investing regularly through good times and bad. So you see, human nature is to get on the train when it's already moving forward. It's slamming forward. You get on the train and then it goes up a hill and goes slower and slower. People get on and off that train at exactly the wrong time. By dollar cost averaging means you're just investing regularly. Every couple of weeks, every month, whatever it may be. And so you're purchasing the stock prices, the index funds. The prices fluctuate, right? But you are buying, when the stock is high, you're going to buy fewer shares because you have so much money. When the stock is low, you're going to end up with more shares. So it's just averaging out over time. Dividends. I love dividends. If you get with a company that pays high dividends, that means over time you've got money coming in every single quarter. Dividends are a portion of profits that are paid regularly by a company to its shareholders. If you're a shareholder, you get part of those dividends. Now, just to complicate things a little bit more, you don't have to take those dividends. You can reinvest those dividends automatically. That's what I did. And that way it buys more shares. So when you do need your dividends, when you do want to withdraw those dividends, they're worth a whole lot more. So you can set up automatic reinvesting of those dividends. Diversification. You're allocating your funds across a variety of investments, and this is don't put all your eggs in one basket theory. You put all your eggs into one particular company and that company goes under. You've just broken all of those eggs and broken your finances. So you're going to spread out the risk. So you want to allocate funds across several different investments. That's diversification. So those are just some of the key terms. People will throw jargon out at you and think you need to know all these other things to get started. You do not. Okay. Basics. Keep it simple. If you don't understand what you're investing in, don't invest in it. So really make sure you understand what it is you're investing. Keep your investments initially in a small number of funds. It doesn't pay to spread it out over 29 different funds and 5 different brokerages accounts. And now you've created sort of a octopus that you are going to have a hard time managing. So keep it simple. Second, I'm on that index fund bandwagon. Invest in index funds. Third thing is automate your contributions. Just set it up so you've got so much money coming out every month so you know what's going in there. Rebalance means you're just shifting money back and forth so that you continue to have that same balance of stocks and bonds. But automate your contributions. That's what you really need to pay attention to. Fourth thing, don't borrow from retirement. This is not your personal account. This is not a bank. Your retirement is set up for you when you're much older. When you retire, you borrow from it. You got to pay that back. If it's a company, you got to pay that back before you leave the company. It's really a loan. Don't do it. It's a really bad habit. Limit your stock buying is number 5. So if you want to invest in a particular company, limit that to maybe 10% of your portfolio. I do have some funds in individual companies that I purchased several years ago, but I've limited that so that if those companies all do bad, it doesn't do a lot of damage to my portfolio. Okay, so keep it boring. Keep your investing boring. Don't gamble your money. Don't get suckered into these get-rich schemes. People give you hot tips. You got to do this today. You got to buy this. You got to sell. Whoa, you start watching those stock market folks, they're going to drive you crazy and you're not going to know what to do. Just keep it boring. Women do better at investing because they're less inclined to listen to all the noise and panic. So you got gender working on your side. Just keep it boring. How do you research the companies? If you are, this is again for individual stocks. So you want to buy into a particular company. Make a short list, Google the company, look under their investors tab, get to know what they own, how do they make money. Yahoo Finance is an easy way to just start checking into companies, see if they pay dividends, see what the recommendations are. Buy shares, really start small. Don't put, $100,000 all at once into these shares, and you're going to you have to, especially if you are brand new to this, you're just starting out, start with a small amount of money because you have to learn how you handle investing, how your mindset works, what you're inclined to do. You're going to be making mistakes. It's just part of the process, part of the learning process. So start small, buy just, small amount of money. Start looking at the prices. If you really feel good about that company, can you add more stocks, buy when the price goes down? Keep learning, get comfortable as an investor. Don't go into investing 303. This is start small, start to learn a little bit more, give yourself the time, and don't be so hard on yourself if you don't do well. A lot of people don't do well. It just, again, start small. Some of the investing resources, the Motley Fool, unfortunately, a lot of this stuff costs some money. So the Motley Fool, yeah, they want you to subscribe to get all their best tips. Cheddar News has, that's another source. Startups and Innovations, Crunchbase. You can look around at these investing resources, see if any of them are good for you. If there's a way to start free or low cost, you might look at that, see what's comfortable for you. You do not have to invest in individual stocks. Many people do not invest in individual stocks. So if this all feels a little bit overwhelming to you, pass it by. It's totally cool. By you investing in index funds, you're going to have a little bit of stocks in all of the companies that are part of that market. So don't freak out if you do not want to buy individual stocks. Here's the big thing. Learn your tendencies. Now, you're going in, you feel pretty good about where you are, what you're going to do, and then the stock market blows up, or something happens, and you do exactly the opposite of what you thought you were going to do. So give yourself time, learn your tendencies. This is Warren Buffett, one of the richest human beings on the planet, and this is he's well known for saying, "Be fearful when others are greedy, and greedy when others are fearful." What does that mean? Bear markets and bull markets. I'm not segueing. This is connected here. So a bear market, and you might have heard these terms and not knowing what are they talking about. What's a bear market? What's a bull market? A bear market is when the stocks are going down. Things are really shaky. There's a lot of volatility. People are pessimistic about the economy. Investors are pessimistic about the future. The stock market is declining. A bull market is the opposite situation. So here, people are, this is a great economy. Unemployment is down. The economy's going great. Prices are just, the stocks are doing well. That's a bull market. So if you're in Warren Buffett land, the bear market offers sales opportunities. So bear market, people begin to freak out because the stock market goes down and people are selling. Oh my God, I got to get out of this. I got to retrieve some of my money. But if you're a real smart investor, you're going to hand select some companies. Yeah, their market, they might have be headed downhill just like everybody else, but the fundamentals are sound. Basically, you're buying these companies at a price. Now, I can give you an example. Because I did this, it was Christmas Eve, and the markets plummeted. And I think this was 2018. So I wanted to make some investments. I had some investments in both Apple and Amazon. Prices went way down, so I bought Apple and Amazon at a sale. So I can tell you, they both have more than doubled since then. So that's how you use that Warren Buffett. Let's go back. I'll show you. Let's say again, be fearful when others are greedy and greedy when others are fearful. So what you want to do is buy when stocks are sale. In a bull market, people tend to hang on. Oh, things are only getting better, only getting great. I'm going to buy in. I'm going to buy more stocks. And they're usually buying at the highest price. So if you're going to sell, you want to sell at the high price, not at the low price. So that's how bear markets and bull markets work, and how you can take advantage of that. If you have worked with an investment advisor, talked to folks about your retirement, seen somebody about how to invest, they might have given you a little quiz. A quiz on what's your risk tolerance, and then they have set you up. Well, you see, you're a low risk person. You're more aggressive. You're okay with high risk. So the questions might be, okay, the economy tanks, and you lose 10% of your assets in 3 months. What do you do? Do you hang on to it? Do you buy more? Do you sell? And here's the thing: the scores are unreliable. So the people who say, you know what, I'm just going to stay in place. I'm okay. I'm going to hold. They're actually selling. They're selling when they get nervous. And the people who are conservative and who say they're going to sell might actually be buying in. So there's no statistical correlation between your risk tolerance score and your actual behavior. So it's not really about a risk tolerance. You have to begin to think about your own personalities. Now, one of the reasons I became a financial coach is that I coach you on mindset. I coach you on how to build financial freedom, but I don't sell you products. I don't want to be pushing a particular stock or a particular product. I'm not a financial advisor. I can't recommend a particular index fund to buy into. If you are really, really uncomfortable and you want to work with a financial advisor, how do you find somebody that's going to give you honest advice, that's going to be on your side, that's not going to try to exploit you, not going to sell you products where they're just making big commissions? That's a hard one. So these are just some recommendations. Look for somebody who is a certified financial planner. Fee-only advisors, they're really hard to find. It means you're paying one fee up front, but they're not receiving a commission. So you're paying them. They're not influenced by those commissions. You're paying them. They're on your side, but they're really hard to find. FINRA, that's an organization that has compliance records. So make sure that there are no complaints against this financial advisor, and interview them. Before you sign up with anything, interview them. And this is an article. Again, go to your PDF. It gives you 9 questions to ask before you hire somebody. Okay, now I've covered an awful lot of stuff. I hope you found it helpful. Ask questions. And again, this is, let me know if you're interested in rerunning this, joining us at another live workshop, any particular angles that you would like me to address. We can do this again. This is Investing 101. So glad you could make it to this mini workshop, and there's lots more coming up. So, hey, Gutsy Women, you guys take care now. Bye-bye.